Second.
Hello, and welcome to this evening's Accident and Sickness Insurance module. My name is Sam Albanese, and I'm going to be your instructor for today's session. We have been receiving quite a few emails in the last little while from last week's session, which is always welcome. So once again, if we go through these things, we may not have time to answer the questions as we go along. Simply write them down for now, then go to your website, get the email address, send it off to us, and we'll be happy to answer them usually, say, within 24 to 48 hours. Also, in this particular section, there is a little bit of math, so you might want to have a calculator next to you, or at the very least a pencil and pads, make some notes and everything else, because this particular section seems to give some of the students a little bit of grief and everything. So we want to make sure that you have the best chance possible of passing, obviously, the certification exam and subsequent, of course, the provincial exam and everything. Okay, so let's get ourselves started, and we'll see where we go. Okay, the agenda, as you know, we're going to review the obvious, the need to know content. We're going to clarify anything that concepts or whatever, and of course, answer any questions either today or by email. Okay, so the first thing we want to look at is why do we even bother with disability insurance? Okay, what's really all about? Well, as the name says, disability basically it's a situation where you're unable to work. And as we all know, we all need cash. Always remember that cash drives everything. And so therefore, without cash, we don't have much. So what it's designed to do basically is protect against loss of income. Sometimes disability insurance may be referred to as income replacement insurance. You may hear that basically as well. So protects against loss of income caused by any kind of disability. It can also cover you for disabilities caused by injuries. In other words, accidents, illnesses, things of that nature there, okay? Now, we all know that we do have a very large social net in Canada. Vast majority of Canadians get some form of disability coverage, either through their employment insurance, Canada Pension Plan, or workers' compensation, group insurance, things of that nature there. So we do have a variety of ways and means of getting that. But none of those really will replace the individual disability insurance. Usually what you find with all these have limitations, and that's where you come in. That's where you are be able to supplement your client's income and everything. So even though there is a social safety net, obviously it won't cover everything. So we need more coverage and everything else. Okay? And of course, self-employed people are automatically covered by CPP, as long as, of course, they contribute to CPP. Remember, the CPP is a contributory plan. And so if you don't contribute to it, you don't get anything basic, but it is available again to self-employed people. EI would not be available to self-employed people. Workers' compensation is not available, and that's why we stress that for self-employed people, the only real coverage that they have is CPP. So for those of you who want to get into that corporate market, keep that in mind, because a lot of them are not covered for the benefits that they need. So let's move on. So there are two kinds of income. This is very, very, very important, and I urge you to listen very carefully, because this is essentially the core, you might say, of how much coverage do I get? What is covered? What is not covered? So let's look at the right side of the screen first of all, where it says unearned income. Another name for unearned income is basically passive income. So you may see sometimes the word passive, sometimes you may see the word unearned. I believe that for exam purpose, unearned will do the job. This is basically income that you receive whether you do something for it or not. In other words, this is income where there is no loss. So the end result here, if you've got rent, for example, then every month you get a rental check, for example. So even if you don't knock on the person's door to get you the check, usually they mail you checks and so on and so forth. So rental income is passive income that you really don't do anything to get that money. Investment income, so that's interest, dividends, and capital gains. Once again, for any of you who may have an investment portfolio, for example, where you're generating interest, dividends, or capital gain, once again, that's not insurable. And the reason why it's not insurable is because there's no loss. See, rental income, there's no loss. Investment income, there's no loss. We cannot insure something that has no loss, okay? Pension income. For some of you who may be on a partial pension from your previous employer, or maybe you're over 50 or something and you're already getting some kind of a pension plan of some sort, once again, that's all passive income. Okay, so once again, because it's passive, because there's no loss involved, therefore you can't get coverage for that. Alimony, for any of you who are receiving alimony, that wants to pay alimony, of course, they have to be insured for that. But the person who's actually receiving alimony, whether or not you become disabled, that check is still going to come along anyways. Okay, so alimony received, once again, is passive income. Royalties. I wrote a book a number of years ago. To this day, I still get a royalty check every quarter, every time a book is sold. Once again, it's passive income, basically. So I don't have to really do anything. So basically, unearned income, the reason why we don't insure is because there is, in fact, no actual loss. What's not and what's missing on that screen, and you should write this down, is trust income. Okay, trust income. So if your uncle or grandfather or grandmother or whatever set up a trust for you when you were a little child or something, now you're an adult, and now the trust income starts coming in for you, that's wonderful. Okay, so that's easy money coming in. But once again, there's no loss, you see. So trust income is also uninsurable. It's passive income. I'll give you an example of trust income in a moment anyways. Let's look now at the left side of the screen, which is what you call earned income. Another name for that is active income. And so you'll find sometimes they call it active, sometimes they call it earned, but basically this is income where if you do become disabled, the income stops. In other words, there is a loss. So what the insurance companies do, they will insure you for earned income. They will not insure you for unearned income. Okay, so your salary or wages, in other words, bonuses you may be getting, that kind of stuff there, those are all earned. And remember that salaries and all that, they could be from various different sources. Some of you maybe have 2 jobs, 3 jobs, whatever it is, have a full-time job and a part-time job. Those are all considered salaries and wages. Those are all insurable earnings. Commissions, of course, for those of you who are entering this business, you know exactly what I'm talking about. It's a commission-driven business, okay? Net research grants. Okay, if somebody gives you a check to do some research for them, once again, they're not going to give you a check if you're disabled. And so therefore, once again, research money basically is earned income. Net business income, for those of you who are self-employed, for example, like I am, for example, for me, all of my income is net business income. So therefore, if I became disabled and any of these things under earned income, that income would stop. So therefore, it is insurable. So the way to remember this is that if it is earned, then there is a potential for loss, and so therefore it is insurable. If it's not earned, in other words, unearned, then there is no potential for loss, and therefore it is not insurable. So on the exam, they're probably going to give you a list of income, let's say $100,000, for example, of income, but that income may consist of unearned and earned. You need to deduct basically the unearned from the earned. Now, you'll see an example in a moment anyway, so I'll go back to this again. The principle behind the earned and unearned part of it, of course, is that the biggest rule as far as disability insurance is concerned is one cannot make more from disability claims than pre-disability income. In other words, if you're making more money staying at home, why would you go back to work? Okay, so the whole idea here is that we must only insure you for the maximum amount, which would be more or less equal to what you were earning before you became disabled. You're not going to be able to earn more than that, because obviously there'd be no incentive for you to go back to work, obviously, okay? So basically, insurers impose this rule by specifying maximum percentage of income that they will cover. In the standard definition of percentage is 60%. In other words, most companies will cover you for at the very least 60% of your earned income. So if on the exam you don't see the 60%, but they ask about earned income, you should know that the default number is 60%. But it could be higher. It could be 65, it could be 70, it could be 75, depending on your occupation and everything else. So basically, for exam purposes, they will tell you what the percentage is. What you need to figure out is what is the earned and what is the unearned, and deduct that unearned from the earned. And then there'll be a percentage. And again, you're going to see this in a moment, because I do have an example. But this is very, very important that you understand the difference between these two types of income. So let's take a look now at some definitions. What constitutes a disability? We all have ideas, you might say, what a disability is and everything, okay? But from the insurance company perspective, these three definitions are crucial. You must know these definitions. You will get a question on the exam on every single one of these definitions. So it's very, very important. Now, once again, on the exam, they're not going to say what is the definition of. They're always going to give you a case study. Okay, they're going to say certain things, and then you have to pick out the right answer. So let's take a look first at the three most important definitions. The first one is own occupation. So when a person buys an own occupation product, a product that has an own occupation definition disability, if they are unable to perform the important duties of one's own occupation. So for example, let's say that you were a surgeon, and I insured you for $5,000 a month, let's say, as a surgeon. Now you have a nasty accident and you lost your arm. So that is the end of your surgery. You can no longer be a surgeon. However, you could be a professor at the University of Toronto Medical School, let's say. Okay, you could run the hospital. In other words, you can manage the hospital. You can have a private practice, family practice. In other words, there are other things you can do. However, you are no longer a surgeon. So therefore, even though you may be gainfully employed as a university professor, earning a very, very good income, the fact of the matter is you'll still continue to get that $5,000. So on the exam, they're going to say, Jack Smith was such and such, a lawyer, a doctor, a surgeon, whatever, had a nasty accident, and he got a disability income of X dollars. And he noticed that when he went back to work, because he could not do his own work, he started something else, but he kept on getting the $5,000. What definition did he have? He had own occupation. See, if you cannot do your own work, you're able to do some other work, but you're still disabled as far as that definition is concerned, you will continue to get that income. Okay? Regular occupation is unable to perform the important duties of one's own occupation and not employed elsewhere. So this is a little bit stricter in that you may go back to work, but you're not able to do the work that you were doing from your employment before you became disabled. So for example, if before you were in a call center, let's say, and you were sitting all day answering the phone and everything else, now because you have a back injury and everything, you cannot sit all day. You can only maybe sit 1 hour a day or something, or maybe not even sit at all. You may only be able to do filing and everything. So the employer is paying you an income for that particular time that you're working. So once again, going back to the example, let's say that when you were totally disabled, you were earning $5,000 a month. Now you went back to work, and your regular occupation definition, in other words, you have that definition is what you purchased, and the employer is paying you $1,000 a month for your partial work that you're doing. Basically, the insurance company will deduct that $1,000 from the $5,000. So in other words, the insurance company will pay you $4,000, your employer is paying you $1,000. So regular occupation, for every dollar your employer pays you, that same dollar is reduced from the insurance company's claim. So it's what they call a linear reduction. So in this example, if you have $5,000 income when you're totally disabled, and now the employer is actually paying you $1,000, the insurance company will pay you $4,000. The next month, it goes up to $1,500, and the insurance company will pay you $3,500, and so on and so forth, basically. Okay? So that's the regular occupation. Any occupation is the strictest of them all. Okay, any occupation basically said you cannot perform gainful employment in any occupation. Any occupation. So the moment you're well, in other words, the moment the doctor says, okay, you're good, you can go back to work, you are now basically off the risk. In other words, the check will stop. So in any occupation, it's a very, very black and white type of situation. You're either fully disabled, or you're fully recovered. There's no give or take on this. Whereas the other two, there is something there that you could get Any occupation is very, very strict. So you can see by these definitions, basically the own occupation is for your upper end, which again, I'll show you in a moment, the upper end market, more your professional market, lawyers, doctors, surgeons, all that kind of stuff, accountants, executives of companies, things of that nature. Regular occupation would be more your white collar workers, office workers, supervisors, managers, things of that nature there. Any occupation, of course, is your lowest. And there will be more like blue collar, light blue collar, dark blue collar, construction, maintenance workers, things of that nature there. So those are basically the occupation classifications. The other definition that you must know is presumptive disability. You will definitely get a question on presumptive disability. So actual fact that you're going to get a question on everything I've said on that particular slide. So please make sure you understand this. When we talk about presumptive disability, it is presumed that you will never recover from your disability. That's what the presumptive disability is all about. It is presumed that you will never recover. And basically, if you are paraplegic or quadriplegic, you lost your eyesight, you lost your speech, you lost your hearing, you're never going to recover from that. So as a result, you don't need to prove loss of income. In other words, we give you that $5,000, you're never going to recover from your speech impairment. You're never going to recover from being a paraplegic. So therefore, what's the point of asking for your income? And we're just going to continue on paying you, and that's all there's to it. Because in other words, you're going to be permanently disabled. So it is presumed that you're going to be permanently disabled, and as a result, even if you go back to work, and there are many, many people, of course, who are, let's say, paraplegics, and they have very, very active lives, but yeah, they're still disabled. And so therefore, under the presumptive disability, even if that person does go back to work, but they have a presumptive disability claim, they will continue to get that $3,000, $4,000, whatever it is that they bought. Okay, and therefore, also the other thing that they do is they normally waive that waiting period. So if you had a 90-day waiting period, for example, but you're a paraplegic, well, there's no point in waiting 90 days. Because you're never going to recover anyways. Okay, so that's the whole idea of presumptive, is that the presumption here is that you're never going to recover. So therefore, we're just going to give you a check basically immediately. What you might want to write down is that on the exam, they're going to ask you, what is it that is not available on group disability insurance? We will talk about group later, but on group disability insurance, and what is not covered on group disability is presumptive disability. The only area that you get presumptive disability is on individual policies. You do not get them on group insurance plans. So what's missing in the group insurance plan is presumptive. You have own occupation, you have regular, you've got all those, okay? But you do not have presumptive disability on group insurance. Presumptive disability is only available on individual insurance. Please make sure you make a note of that, because you definitely will get a question on the exam on that, okay? So here's an example, okay? So when you were totally disabled, whichever one you happen to have, whichever definition you bought, okay, whether you bought own, regular, or any, okay, we paid you $5,000 when you were totally disabled. And then you had a treatment, okay? So number 2 there, you see there, it says a treatment basically on the screen. And you have that treatment, but you were not able to do your own work, so therefore the $5,000 kept on coming. You were not able to do your regular work, so therefore the $5,000 kept on coming. But if you notice on any occupation, because the treatment is not complete, you get nothing. In other words, that's it, it's over with. So like I said, in any occupation, you are either totally disabled or you're totally recovered. There's no middle ground in this whatsoever. Okay? So let's go on. Let's say that you have that accident and you decide to go to the University of Toronto and lecture, let's say it's a medical school or whatever, and the university is paying you $3,000. If you were a surgeon or if you had that own occupation, because you're no longer doing your own occupation, that $5,000 will continue to come. Whereas if you have regular occupation, because the university is paying you $3,000, then the insurance company is only going to pay you $2,000. You can see there that regular occupation is for every dollar the employer pays you, you get a reduction in what the insurance company will pay you. Obviously, when you recover totally, then obviously the disability claim is finished. Okay, so it is important that that you understand the difference between these 3 definitions, because this again forms the core of the disability insurance business, basically. Okay, so how do we classify So we talked about different definitions. Well, who gets what? Well, essentially, these are the occupational classifications, okay? Everybody that applies for disability insurance will fall into one of these categories. So the very first thing you ask an individual before you even start talking about the wonderful benefits of disability is you need to establish what is the occupation, what is it that they do. And it's not so much a title as much as what is it, what are their duties, you might say. So if you can see there, the 4A, that is the top of the food chain. So this is your professional bodies, doctors, lawyers, dentists, presidents of companies, senior executives, senior vice presidents, things of that nature there. They are, of course, the top of the heap, food chain, as I always call it. Okay? 3A is more administrative office workers, who basically, clerical staff, and for all intents and purposes, there's minimal, if any, risk at all. Okay, so 3As. 2As would be, again, white collar work, but more towards salesperson, low risk environments, things of that nature there. The A's and the B's, you can see, this is the skilled manual workers, and then, of course, the manual laborers themselves, which is the dark, sort of the dark blue collar, or the B's, the light blue collars, and the A's, you might say. So the very first thing that insurance companies will ask you when you're selling disability is, what does this guy do? And then once you tell them what they do, then they classify you, and based on that, then you buy, they can buy certain kinds of products. Okay, so the idea of the occupational classification is to establish whether the applicant is insurable or not. Like, it's no point in talking about how wonderful disability insurance is if the person is simply not insurable. In other words, nobody would cover that individual, that occupation, that sport, whatever that may be. Okay. Once we've established whether the person is insurable or not, then we establish types of policies that are available. Not everything is available for every single classification. You're going to see that what's available for the professionals, for example, may not necessarily be available for the manual labor. So we're going to establish what kind of policies are available. Then we're going to establish what kind of riders and other benefits that may be available for that occupation class. Okay, and of course the premium coverage. Okay, the premium coverage. The cheapest of the disability, of course, is the any occupation, because that's the one that gives the insurance companies the greatest protection, and it gives the consumer the least protection. Because, like I said, with any occupation, as soon as you get to work, that's it, it's over with. So the most expensive would be the own occupation, because you're transferring all the risk to the insurance company. Next to that would be regular occupation, and again, the cheapest one would be the any occupation, because you as the consumer are taking on some risk yourself. That the moment you get back to work, that's the end of the payments and everything else. And again, we're going to get back to some of these definitions in a bit anyways. Okay, so let's take a look now. Remember I said to you that there is a formula that is applicable when you try to figure out how much disability insurance actually a person needs or qualifies for. So here we have Josh. He's a sole proprietor working as a consulting computer technician. Most years he earns $70,000 in consulting fees. The insurance company would offer a maximum disability insurance coverage of 60% of his gross income. What is the maximum disability benefit that the insurance will give Josh? So it's very quite simple. It's earned income, which is in this case here, the consulting fee of $70,000, times the benefit, which is in this case is 60%, is $42,000. So 42,000 divided by 12, because disability insurance is only applicable, paid out on a monthly basis, they get $3,500 a month. So you can see there, the formula is really quite simple. It's earned income times the benefit equals whatever. In this case here, 42,000 divided by 12, and in this case is $3,500. So it's quite straightforward. Where the mistakes usually are made, you're trying to figure out what is the earned income. Basically, that's where usually the mistakes are made. So as I said before, we don't insure unearned income. We only insure earned income. So let me give you an example of that situation. So here's the next one. Josh is a proprietor, working as a consulting computer technician, $70,000 consulting fees. However, he received $20,000 from a trust. This, of course, is unearned income. So the insurance company would offer a maximum disability coverage of 60% of his gross income. What is the maximum disability benefit that will allow that they'll pay Josh? So in this case here, we've got $70,000 worth of earned. We then add the unearned, in this case, $20,000. Okay, so times 60%, and that's $54,000. Okay, so basically, it's 90,000 times 60% is 54,000. But this is where it becomes interesting. Remember, I said to you that we don't insure the unearned portion of which the trust income. So the insurance will allow 54,000 minus that $20,000 of unearned income. So that drops his earnings now to $34,000 annually. Once again, divided by 12, so he gets $2,833 per month. See, so that's why it's important. So what you do when you get that kind of a question, when you get a question of earned and unearned, add the whole thing up, multiply by the benefit. In this case here, the benefit was 60, and all the income was 90,000 times 60%, 54,000. Then you deduct from that 54,000 the unearned portion. In this example, was 20,000. You've got $34,000 left, and then we're divided by 12. So in our example, we've got $2,833. You will definitely get a question on both of these slides. So it is very important that you understand how this works. And again, the book does a very good job of explaining this as well. So please make sure you read over the examples that are in the module 2 there. Okay, let's go on. Now, once we've established how much the coverage will be, depending on this person's income and everything else, okay, the next thing we have to establish is the benefit period. In other words, how long will these payments continue? And of course, as assessed in the slide, it's 1 year, 2 years, 5 years, 10 years, or age 65. 1 year is kind of unusual. Most of the time, it's 2 years, 5 years, 10 years. Now, that doesn't mean that the policy expires. Let's say you had a 10-year benefit period. It doesn't mean that at the end of 10 years, the policy has expired. No, the disability insurance all disability insurance expires at age 65. Okay? What we're saying, if you have a 10-year benefit, what they're saying is that for that particular disability, the maximum payments that you're going to get is 10 years. So that means that at the end of 10 years, even if you're still disabled, yes, the check will stop, but you're still covered. So if you have another disability, for example, they'll obviously pay you again, because remember, you can have multiple disabilities. So all we're saying is that the benefit period doesn't mean that the policy expires at the end of the benefit period. All we're really saying is that we had a payment period of 10 years, 5 years, whatever. So the most common is 2 years, 5 years, 10 years, age 65. Very rarely you get 1 year. The other thing that you have to establish is the waiting period or elimination period. In other words, how long before a check has to arrive at your doorstep. And once again, basically you can pick up steps at 0 days, for example. That's very expensive. So again, it's very rare. Most of the time, 0 days is for accidents. And then for sicknesses later, But yes, you can buy a 0 day, but like I said, it tends to be rather expensive. 15 days, 1 month, 2 months, 3 months, and so on and so forth. Okay. The longer the waiting period, the cheaper the premium. Okay, so one of the questions on the exam will always be, is the client says, I need $5,000 a month, but the premium is too high. What can you do for me? Well, the first thing you can do is extend the waiting period. So if you have a 90-day or 3-month waiting period, for example, you may want to stretch that to 4 months. That lowers the premium considerably. So by extending the waiting period, it lowers the premium. The other thing you can do is lower the benefit period. In other words, if you had a benefit period from age 65, you may want to say, okay, what about 10 years? That'll also. So by lowering the benefit period and by increasing the waiting period, the premium is reduced considerably. Yes, as a last resort, you may have to lower the 5,000 to 4,000. Okay? Usually we try to say, do not impact the benefit, but you have these two levers. Okay, the benefit. Play around with the benefit period and play around the elimination period, basically to reduce the cost and everything. Try not to minimize the benefit itself. But as a last resort, yes, if the person would like to have 5,000, but they can only afford 4, obviously you're going to use that as well. Okay, but that's usually a last resort type of situation. Again, you're going to get a question on the exam about the cost of these and what can you do to mitigate that issue. Okay. Let's go on to the different types. Now, we talked about 3 different kinds of disability definitions: home occupation, regular occupation, and any occupation. Now, we have to look at the 3 different kinds of policies that are available. Okay, so the first one is what we call non-cancelable policy. very, very important to understand the definition of non-cancelable. Basically, when a client buys a non-cancelable policy, that basically means that the insurance company has taken on all the risk. In other words, they cannot change the benefit period, they cannot change the premium, they cannot change the waiting period, they cannot change the amount. In other words, the client pays the premium, the insurance company pays the claim, period. Okay, so this is obviously the most expensive kind, and this is where the own occupation definition tends to stay. It's a non-cancelable. So this is where doctors, lawyers, and professional people tend to buy non-cancelable policies, because in a non-cancelable policy, the insurance company is basically stuck. As long as that client is paying that premium, they have to abide by whatever they give. So even if they're losing money, even if the insurance company is losing money, they cannot change the premium. They cannot change the benefit period. They cannot change the waiting period. They can't change anything. They're basically, what you've done is you transfer the risk from yourself over to the insurance company. And it's a fully 100% guaranteed product, no questions asked, basically. Okay? The next one is guaranteed renewable. So the word guaranteed here is very, very important. Okay? In that, in a guaranteed renewable, the thing that we cannot do is cancel the contract. Okay, in other words, we are going to guarantee that we will always insure you until age 65. So every year, this will automatically renew until age 65. At that point, of course, all policies end anyways. However, how does the insurance company protect itself against bad claims? It can change the premium. So on the exam, they're going to ask you, what is the single most important thing to explain to the client when they buy a guaranteed renewable policy? And the most important thing to explain to a client when they buy this kind of policy is how the circumstances that will lead an insurance company to increase the premium. Okay, so because on the guaranteed renewable, what we're saying is, yes, we'll renew it. That's not a problem, but we're not going to guarantee the price. We're not going to guarantee the premium. So if we end up we're not making any money or whatever, the claims are too high, then next year we're going to increase the premiums. Now remember, when we say increase the premiums, we're going to increase the premiums for everybody, not just you as an individual. So in other words, we can't discriminate here. So everybody gets impacted by the increase in premium. The last one is the cancelable policies. This is the one where the insurance company has the least amount of risk, because the risk is shared between the client and the insurance company. Because in a cancelable policy, the insurance company can cancel the risk. In other words, if they're losing money in that particular classification. So for example, you may be losing money if they're insuring a bunch of truck drivers, for example. Can they say, my God, the claims are too high. I think we're going to get out of the truck driver business, or we're going to get out of the construction business, or whatever. Okay? So a cancelable policy basically allows the insurance company to cancel the premium, the policy. So again, on the exam, what they're going to ask is, what's the most important thing to explain to a client about a cancelable policy? And that is the circumstances under which a policy can be canceled. Okay, so those are the three definitions that you have. So you can see there that the cancelable policy is essentially in any occupation definition. Guaranteed renewable essentially is a regular occupation definition, and non-cancelable policy is an own occupation definition. So you see the connection here between the types of policies and the definition that you actually have. And that should help you in answering those questions. Okay. And again, the book does a good job of explaining all these definitions, so please make sure you read them at your leisure. Let's go on. So what happens if an individual has any of these policies, let's say, and they're not totally disabled, but they're partially disabled? In other words, they cannot work the complete time or perform the duties that they were normally able to do. Okay, is there anything available to them, or is it just going to be completely canceled and that's it? Well, if they don't want it to be completely canceled, they can buy what's called a partial disability rider. And basically what happens is that you get 50%. In other words, if I gave you $5,000 a month in our example, and you have a partial disability definition attached to that as well, and you were able to do some of your duties, but you're not able to do all the duties, you would get at least $2,500 basically, so 50%. So partial disability is quite straightforward. It's 50% of whatever you were entitled to, and that's the amount. Okay? So this kind of partial disability generally short term, in other words, 3 to 6 months. So this is not forever. So it's a very short space of time to give you sort of time, you might say, to recuperate without a loss of income. Okay, so and then after 3 to 6 months, basically theoretically, you should be back to work, and then you get full employment anyways, and that's it. So the partial disability tends to be more for that 3A and lower, 2A, things of that nature there. Okay, so in other words, for the light blue collar, dark blue collar type of environment, and so therefore, the client can at least get some money rather than a complete cancellation of the benefits. The next one is very, very important. You will definitely get a question on this because this is extremely, extremely popular. It's what we call residual disability. The word residual is important. The definition of residual is percentage loss. In other words, what is the percentage loss? So for example, let's say that you are working 1 day a week. That means you're working 4 days a week. Okay, so you're not working 4 days a week, so you're only working 1 day a week, so you're not working 4 days a week. But if you're working only 1 day, that means you're working 20% of the times. So your percentage loss is 80%. Okay, so therefore, in our example of the $5,000, for example, and let's say if you were only working 1 day a week, which means that you're still losing 80% of your income, the insurance company would pay you 80% of the $5,000, which I believe is roughly around $3,500 or something, whatever. Okay, so basically, residual is a percentage loss. So on the exam, it could be a situation like that where they say, you only work 1 day a week. What's the percentage loss? Well, obviously 30%. Or they may say I'm working 40% of the times. That means you're not working 60% of the time. So 60% of $5,000 is what you're going to end up getting. Okay? A more common way of doing it is the formula that's sitting in front of you right there, the loss percentage. What was the earnings pre-disability income? And what was your earnings post-disability income divided by your pre-disability income? So for example, if your pre-disability income was $10,000 a month, now you went back to work and you're only earning $5,000 a month, so post-disability income is only $5,000, divided by the 10,000 is 50%. So you're going to get 50% of the $5,000. Okay, that's $2,500 in our example. Okay, so this is the formula that you probably should remember. Is because most of the times on the exam, this is the one they actually use. They will tell you how much the person gets when they're totally disabled. In our example, say 5,000. Then they will tell you the day before you were disabled, you were earning $10,000. After you became disabled, you came back to work, you're only earning $5,000 divided by your pre-disability income. That's 50%. So therefore, 50% of $5,000. Here's the you're going to check for $2,500. Okay. So the residual benefit basically is designed to pay you if you lose a certain amount of income. Okay, percentage of income, basically. Okay. So a 0 to 20% loss, the residual doesn't kick in. It does not kick in. But 20 to 80%, that's where the formula kicks in. So in other words, loss percentage times the total disability benefit. Okay, so if on your loss percentage is anywhere between 20 to 80%, you need to multiply that number times the total disability benefit, and that will be the amount of money that the insurance company will pay. If the client is making over 80% or more, they're basically no longer disabled, so therefore there's no disability benefit. So in other words, it's completely paid for, and that's because you're now fully recovered, basically. Okay. So the residual is very, very important. Once again, on the book manual, it does gives you a couple of examples of that. So please make sure you review that. But here's one for you, just again because this is so important. I decided that I should have one for you here as well. So here we got Bruce earns $8,000 per month as an interior designer. There are no group benefits for him. So Bruce acquires an individual policy benefit and he gets $4,000 per month with the residual benefit. So therefore, when he becomes disabled, he gets $4,000 a month. Okay, that's basically it. Bruce suffers a fall, and after the qualification period, returns to work for 3 days a week, and he earns $4,500 per month. How much will receive as residual benefit? So as I said, the loss percentage is the formula you need to use. So the pre-disability income was $8,000 a month. Post-disability income is $4,500 divided by 8,000. So he's losing 4,375%. Okay, 43.75%. So the residual benefit then is the loss percentage, which in this case is 43.75, times the 4,000, which of course was the full benefit that he was getting. So the insurance company will pay him $1,750. Okay. So if on the exam, all they ask you is the residual benefit, then you would say in this example, he's going to get $1,750 from the insurance company. If they ask you how much would be the total income, then you need to add the post-disability income along with the residual benefit. In other words, the post-disability income is his employer's income, which is $4,500, plus the insurance company income, which is $1,750, so $6,250. So in the example I've given you here, it says how much will he receive as residual benefit. So if it stops there, then it's $1,750. But sometimes on the exam, they may go one step further and say, what is the total income? So if on the exam, they say total income, then you have to add the income that comes from the employer and the income that comes from the insurance company together. And in this case here, is $6,250. So I hope that's clear because it is a very, very important question. Okay. So the other thing, this looks very, very complicated, but in actual fact, it's not as bad as it appears. So without going into too much detail of all these arrows and everything, I'll tell you what this is all about. Basically, what happens is, let's assume again that you were getting $5,000 a month when you were told disabled. Then you went back to work. And within 6 months of going back to work, you became again disabled from the same disability or related to the same disability. Okay. In that case, what happens is you will continue to get that $5,000 a month without a waiting period. In other words, the waiting period is completely waived. So in the first example, without recurrent disability provision, this individual had a 3-month waiting basically period, and he had a heart attack. He went back to work after 4 months. Then he became disabled again, okay, because he had chest pains, but because he didn't have a recurrent disability provision, if you notice, the waiting period starts again. In other words, the waiting period of 3 months, it starts again. That's what this is all about, you see, because we had a waiting period of 3 months, but because he did not have recurrent disability rider, in other words, he didn't buy that, even though after 4 months, he went back to work, and within 4 months of going back to work, he had chest pains. So therefore, it's related, obviously, to his heart attack. The 3 months is instituted again. So as a result, he's going to have to wait. But if he has a recurrent disability provision, in other words, he has a rider, has a recurrent disability. Again, he has a heart attack, 3-month waiting, all that sort of stuff there. Goes back to work. Within 4 months, he goes back on disability. But because it's a chest pain, which is, again, part of the heart attack, he gets an immediate benefit of $5,000 again. In other words, the $5,000 is reinstated right away, essentially, okay? So with the recurrent disability, the key element is that if you go back to work, and within 6 months of going back to work, you go back on disability for the same issue or related to the same issue, there will be no waiting period. So the benefit starts immediately, and the benefits just continue on for the entire benefit period. Okay. So as it says here, the disability must be from the same cause, and it must occur within that period, like I say, within that period of 6 months. Okay. So again, the book does a good job of explaining what that's all about, and you will definitely get a question about recurrent disability as well. Okay. Like any kind of risk, there are certain risks that we simply, as an insurance company, will not cover. Okay, it's as simple as that. Obviously, we're not going to cover for if you get injured during a war, whether it's declared or undeclared. If it's a war, you will not get covered. Okay, we are not going to get coverage for terrorist attack, which is unfortunate because of what we see around the world today, unfortunately. But terrorism is not covered under disability insurance. Obviously, self-inflicted wounds, in other words, you stab yourself or you cut your own hand off or whatever it is, we're not going to pay for that. Okay. Attempted suicide, once again, we're not going to pay for that. Illegal activities. So, for example, if you robbed a bank and the process of running out of the bank with the loot of money, you stumbled on a chair and you broke your leg. Okay, you're not going to get paid. So, if you are disabled in the process of committing a crime of some sort, robbing a bank, stealing a car, bombing a building, whatever it is, in other words, some kind of illegal activity, and you get disabled, get injured, or whatever it is, you're not covered during that for that particular situation. Okay, and of course, normal pregnancy, complicated births, of course, yes, you are covered. For normal pregnancy, the usual morning sicknesses, things of that nature. There, no, you are not covered. So every insurance company has these provisions. These are what they call statutory exclusions, basically, that pretty well every company out there has similar definitions and everything else and exclusions. Okay, so disability insurance, of course, is also available on group disability. Okay, many of you maybe who have worked for an employer or maybe have clients who are employers and everything else, or clients who are working for a company, they'll probably have group benefits. So we have what's called long-term disability policies available, and we have short-term disability policies. Okay, so basically the short-term disability is for a limited period of time. Usually 12 months, many times less than that. It tends to coincide with EI. We will be talking about employment insurance later. So I sort of merged with EI for 17 weeks. And that's why you'll notice that with the STD, basically it's for a very limited period of time. Okay. Once the short-term disability expires, the long-term disability kicks in. And long-term disability tends to be, again, for 2 years, 5 years, 10 years, and age 65. So short-term disability is, generally speaking, no more than 12 months. Long-term disability kicks in the moment the short-term disability expires, and it will go on for a period of 2 years, 5 years, 10 years, and into age 65. So all depends on the group insurance plan that you have and everything else. Okay, so that's available on group disability. But remember, I said to you that on group disability, presumptive disability is not available. So all the other stuff that we were talking about, the definitions, regular occupation, own occupation, all that, those are all there, but not presumptive disability on group insurance. Okay. One of the worries that we have when a person has coverage on group disability is the question of too much insurance. Okay, obviously, what we don't want is overinsurance, because if we overinsure you, then there's no reason for you to go back to work. If you remember the very, very first slide that I showed you, was that insurance companies do not want to make more money or earn more, basically, when not working. They want you to learn no more than what you were making before you became disabled. And so therefore the incentive obviously is for you to get back to work. So how does the insurance company protect itself against overinsurance when you have a group client? So they have group benefits, but they also have individual benefits, let's say private plans, things of that nature there. Okay, and so therefore how do they protect themselves against all that? And basically, they protect themselves by two different things. The first one is what they call all source maximum, right there, all source maximum. And that basically means that they're going to take a look at where is your income coming from. And so they're going to say, all right, other than the group disability benefit that you're getting from us, is there any other income that you're getting? And they may say, and you may say, well, yes, I'm also covered by another group plan because I work part-time and say McDonald's or something, whatever. They're going to then offset, okay, because you cannot make more money post-disability than you were making before you were disabled. Okay? So they're going to look at your sources of income, and then they'll scale it back. Basically, they'll begin to go down to what they call the maximum overall, things of that nature there. So for exam purposes, basically, all you really have to worry about is that the two mechanisms that they use. First one is all source maximum. The other one is in the pink side here, group offset amendment, and that is very, very specific. In other words, if you're getting money from CPP, that may be, then we can lower your LTD benefits. Okay? If you're getting money from workers' compensation, you may also not get any money from your LTD because workers' compensation may pay you the maximum amount of money, and so therefore your long-term disability, your group insurance plan will not pay you. Okay, it could also be a situation, for example, in your car insurance. Through your car insurance, you had an accident, and your car insurance company will pay you an income. That is considered also as a group offset. And so therefore, the two mechanisms that insurance companies will use to try to minimize the possibility of overinsurance is all source maximum and group offset. And that's really all you need to know for exam purposes. Every group insurance plan, disability plan, has these two provisions in there, and as they're designed to make sure that you're not taking home more money, staying home, basically. The next thing we have to look at is taxation. This is very, very important. Again, you're going to get a question on the exam about this. Okay. Basically, if the employee pays the premium for the group disability benefit, okay, then the benefit at the other end will be tax-free. So let's say that the premium was $1,000, at that $1,000 a year, and your benefit is $3,000 a month, let's say, and you became disabled. Even though your employer has been deducting that $1,000 from your paycheck, you're paying for it. Okay, you're paying for it. So because you are paying for it, therefore the $3,000 you're getting when you're disabled will be tax-free. If, on the other hand, the employer is paying $1,000, you're not paying for it. In other words, you don't see a deduction in your paycheck or anything for the $1,000. That means the employer is paying for it. Then the benefit becomes taxable. So basically, the moral of the story is that if you pay the premium, the benefit is tax-free. If your employer pays the premium, the benefit is taxable. That's really what you have to remember. Okay. And by the way, if it's 50-50, sometimes it can happen where you pay 50% of the premium and your employer pays 50% of the premium, in which case that 50% of the benefit of the $3,000, let's say, would be taxable. So $1,500 would be taxable. The other $1,500 will be tax-free. So there's a direct correlation between what you're paying and what the employer is paying in terms of taxation. So you need to make sure you know that, because they will definitely have a question on the exam for that. Okay. Also, on group insurance, all group insurance plans have a 31-day conversion period. So if you lose your job, either you get fired or you quit or whatever it is, you have 31 days from the day of losing your position. You can convert your plan to a private plan, an individual plan, at the attained age rate, but without medical evidence. Remember, that whole idea of conversion, is that without medical evidence. So it's like term insurance conversion without medical evidence. But you must do this within the 31 days of losing your employment. If you do it after that, you will be subject to insurability aspects, and if you're uninsurable, well, then that's the end of that. Okay. So there is a conversion privilege, but you must exercise that option within 31 days. And if you do that, you do not have to give us any kind of evidence of insurability. You simply pay the attained age premium that the insurance company will charge you, and you're covered. Okay. Let's take a look now at some of the government benefits that you get when you when you're living in Canada, basically. Okay? And all of you are familiar, and probably most of you are covered by these as well. The first one, of course, is the employment insurance, EI. Okay? So EI basically is a contributory plan. So the employer pays half, essentially, and you pay half. Basically, so it's a contributory plan. The waiting period is 14 days. So the first 14 days you get nothing. So the benefit starts on the 15th day, and it goes on for 15 weeks. So a total of 17 weeks is what you've got. But 2 weeks you're not going to get any pay, and the other 15, of course, is the benefit will be paid out. The benefit is 55% of your insurable earnings, up to a maximum. And that maximum changes year by year. I believe this year it's around $530 a week or something like that, whatever. So it's 55% of your insurable earnings up to a maximum of. And don't worry about the maximum, because like I said, it changes every year according to inflation and everything else. The important thing here is the definition here is that you cannot do any of your regular work. So in other words, it is a regular definition type of situation, okay? Also, there is no death benefit, and there is no children's benefit, and there is no spousal benefit. So this is strictly benefit for you as the EI employee. Basically, that's it. The benefit is taxable. So you will get basically a T or something or other, basically, that. So you do have to report this as income. So it is taxable benefits. Okay. The next one is kind of the pension plan. And here, the waiting period is 4 months. Okay, I should tell you that the definition here, as it says there, is very important. If you remember, we talked about own occupation, any occupation, regular, all that sort of stuff. It does not apply here on CPP. The definition for CPP is that the disability must be severe and prolonged. That is, it's a very strict definition. So it has to be of severe nature, and it has to be for a long period of time. And so, therefore, this one here, it's not a situation of any occupation, regular occupation, all that. It is a severe and prolonged definition, so it's really quite strict. Anyway, the waiting period is 4 months. Benefit period to age 65. So you don't get the 2-year, 5-year, 10-year, and all that. It is age 65. So this is a very strict type of situation. Once again, the benefit is based on contribution. How much you get will be obviously as to how much you actually put in. The employer and the employee, of course, put in the money. They pay for all this. If you're self-employed, you pay the entire amount yourself. If you're employed by a company, then your employer pays half, and you pay half. So, but the entire amount is taxable, just like the EI is, split 50-50 as well, okay? And is taxable. CPP is also taxable. There is no spousal benefit. There is a death benefit. That death benefit is up to $2,500. Okay? There is a children's benefit. Okay? The children must be minors, in other words, up to age 18. In other words, they're dependents, or 18 to 25, but full-time at school. Full-time at school. As long as they're 18, 25, full-time at school, they will also get a benefit. I believe it's around $255 a month or something, But again, all of it is taxable. All of it is taxable. So it is very important that you know the definition of Canada pension and the benefits that you get. The last one is workers' compensation. And this is basically covers you for 8 hours in other words, only during the time you're actually working. Whereas EI and CPP and your individual disability policy and your STD and LTD are 24/7 coverage. Workers' compensation is not 24/7 coverage. It only covers you during the time you're actually working. So if the accident or the injury or the sickness is a result of a workplace situation, workers' compensation will cover you for that. Okay. If by chance that situation is outside of work, you will not get paid. Whereas Canada Pension, EI, STD, LTD, and all that, they'll all pay you. Workers' compensation will not pay you. You have to be on the job. Okay, and it will pay you up to 90% of your net income. So the amount is adjudicated, so it can change basically. There is a death benefit. Once again, it's adjudicated. Okay, the benefit period could be for life. In other words, it could be a lifetime pension until the day you die, or it could be for a limited period of time. It's all adjudicated basically. So workers' comp is an adjudicated process basically. Depending on the adjudicator, they will decide how much you're going to get, or how long you're going to get it for, and so on and so forth. There is no spousal benefit, and there is no children's benefit. Okay, so this again is strictly coverage for you, period. Okay? The nice and the good news of all of this is that workers' compensation is tax-free. So the money you receive from workers' comp is tax-free. Unlike EI and CPP, where it is taxable income, workers' compensation is tax-free. So non-reportable, you don't have to worry about paying taxes on workers' comp. Again, the book does a good job of explaining these, so please make sure you read over that at your leisure. So there are a number of riders, You remember with life insurance, we talked about last week the various different kinds of riders that you could add on life insurance. You can also add riders on disability insurance. And these riders, again, enhance the product and make it more attuned to the needs of the client. So they fit the client's needs, their budget as well. So in other words, they can make this into a plan that fits their budget, fits their particular needs. So let's take a look at them. And I can tell you, you will need to know the definition of each one of these. You will get a question, at the very least, the first three. You may get the question for the last two, but for sure, the first three, because these are very, very popular. So the first one is future purchase option, FPO. Every insurance company out there will be delighted to insure you and give you more disability insurance in the future, as long as you are insurable. Okay, as long as you are insurable. But what if you're not insurable? What if something happened to you and you cannot buy any more insurance? Now, what are you going to do? So let's say you were 25, 30, whatever. You just graduated and you're now a doctor. You're now an engineer, whatever. Okay, and your income is very low at that time. So therefore, 60% of a low income is a low income. So let's say that all you were able to get was $1,500 a month. That's all you could get because your income, that 60% only allowed you to get $1,500. But your income is going to increase over the years. And therefore, over the years, your needs for disability insurance will also increase. You want more coverage. And as I said earlier, the insurance company will be quite happy to give you more disability insurance as long as you're insurable. But what if you had an accident? What if you're uninsurable? How can you now buy more disability insurance without medical evidence? Well, if you purchased when you were 25 or 30 years old, you purchased a future purchase option, FPO option, as a rider onto your plan, every 3 years or so, the insurance company is going to send you a letter. And they're going to say, good news, you now qualify for an extra $1,000, an extra $1,500, whatever that happens to be. Okay? It's signed right here. So all you do is you pay the attained age rate, but you do not have to worry about insurability. So even if you're uninsurable, they still have to cover you. They cannot turn you down. So the future purchase option on the exam, they're going to give you a question. Jack Smith, it's got this, that, and the other, but he's concerned about the fact that in the future his income will be increasing and he wants to make sure that he can buy more insurance in the future. What option should you add to his plan? The answer is future purchase option. Okay? So future purchase option. Okay? The next one is cost of living adjustment, COLA. This is for the individual who says, that's great, $3,000 a month, that sounds pretty good, whatever. But inflation erodes the purchasing power. How can I protect myself against inflation, erosion of my $3,000? Because 10 years from now, $3,000 may only buy $2,000 worth of goods. I want to make sure that it always buys $3,000 worth of goods. That what they're saying is, give me an inflation fighter, and that inflation fighter is COLA. Okay, cost of living adjustment, COLA. So here you can go according to consumer price index. You can go 2%, 3%, 4%, whatever, whatever it is, and then pay accordingly to whatever it is that you buy. So what happens here is you're not actually buying any more insurance like the future purchase option. You're actually buying more. Okay? With COLA, every year it just goes up according to whatever you purchase. So if you purchase according to CPI, what will happen is once Ottawa says the consumer price index for the year 2017 was X, therefore your COLA now automatically increases by X, and that's it. You don't have to do anything. You don't have to prove insurability, none of that stuff. It just simply goes up according to CPI or 2% or 3%. So this is for the individual who's saying is, I'm concerned about my purchasing power. What can you do for me? Okay. The next one is return of premium. This is extremely popular. Okay, ROP. What if you buy disability insurance? You're paying $2,000 a year from age 30 all the way to age 65, and you never, ever had a disability. In other words, you've never had a claim or anything, But if you had a return of premium rider, what they'll do is they will return, most companies will return up to 80%, sometimes even more, but 80% of every dollar that you have paid out in premiums all those years, since you never had any kind of claim whatsoever. Okay. So the ROP is really an interesting rider because you can say, well, if I become disabled, I'm going to get an income. If I'm one of the lucky ones, nothing ever happens to me, at the end of the period, when I cancel the plan or it expires or whatever the case may be, I'm going to get up to 80% of all my money back, tax-free, because that's just a return of your own money. So again, you have to look at the definition from your insurance company, because some companies will say, if you never had a claim, we'll give you 80% of your money. Some companies will also say, if you did have a claim, we will deduct that claim amount. So in other words, let's say they owed you $60,000, but you did have a claim for $20,000, then they'll only pay you $40,000. So you have to look at the insurance company in question, basically. But the ROP is a very interesting rider because, like I said, if you're one of the lucky ones that you never really used it, or if you did use it maybe very sparingly, you're going to get a lot of that money back at the end of the day anyways. Okay? First day hospitalization, this is basically for accidents. So in other words, if, for example, you had a 6-month waiting period, but you want a first day accident hospitalization rider. So usually first day hospitalization is very useful if you have long waiting periods. If it's a short waiting period, 30, 60, 90 days, you probably wouldn't bother with first day hospitalization. But if it's a long waiting period, then you may want to have a rider that in the event that you had an accident and you were admitted to the hospital, you don't have to wait 6 months before you get an income. Okay, you're going to get income right away, basically, first day hospitalization. It tends to be a little expensive, but once again, read over your company's direction and everything else. You see what I'm talking about. And the last one is hospital indemnity rider. And this is really a rider that you can add that will pay for people visiting you in the hospital. In other words, if your loved one has to come into the city of Toronto, let's say, but they have to pay parking, they may have to stay overnight, all that kind of stuff there because they live far away, but they want to visit you. You can get up to anywhere between $50 a day right up to I've seen some up to $250 a day, depending on what you buy and everything. So it's really to cover, you might say, the expense of visitors coming to visit, loved ones, basically your family coming to visit you. So it's a further coverage over and above the $3,000, $4,000 that you're getting from your basic policy. You're also going to get an additional amount of money for basically covering costs of family members attending at the hospital. Okay, like I said, the likelihood is you may not get a question on the first day or the hospital, but you will definitely get a question on FPO, COLA, and ROP. Those are very, very common definitions. Okay. Next thing we'll look at is critical illness. This, of course, used to be called dreaded disease. Now it's called critical illness. And it looks like life insurance because it pays a lump sum. So basically, it pays lump sum benefit if the insured is diagnosed with a listed condition and survives 30 days. Okay. In other words, the waiting period is 30 days. So the what we call the 4 big ones. They're not on the screen, but they are in your book. You must know the 4 big ones. And the 4 big ones are basically the heart attack, stroke, cancer, and heart bypass surgery. Okay, so heart attack, strokes, cancer, and heart bypass surgery. If every company that sells critical illness in Canada must at least provide those 4. They can certainly add more, and many companies, of course, have done that. Okay, they've got 20, 30 ailments and everything else, okay? But at the very, very least, they must be able to cover the big 4, which is heart attack, strokes, cancer, and heart bypass surgery, okay? So from the date of diagnosis, you have to survive 30 days. In other words, if you had a heart attack and you instantly died, this will not pay. Okay, you must have that heart attack and then survive for 30 days, and then it will pay. And you die after that, that's fine, but the waiting period is 30 days. If it's a brand new policy, you have a further 30 days. In other words, a qualification period. So for brand new policies, you basically have 60-day waiting period. 30-day to qualify, and then 30-day waiting period. Once that 60 days is finished, the only thing you have to worry about is a 30-day waiting period. So in other words, no benefits will be paid for any condition diagnosed within 30 days of the policy issue. Okay, we're not going to pay anything at all within that period of time. And once that's finished, then of course you are covered. Okay, So the big four, make a note of that. You must know those big four. So on the exam, they're going to ask you all the following are covered under critical illness except diabetes, let's say, something like that. You know what I mean? In other words, it's the big four that are covered. That's all you have to remember. The other benefits, don't worry about them. It's just strictly the big four. Okay? Of course, you can buy, depending on your ability to pay and everything, you can buy different kinds of coverage. You can buy term insurance, 10-year renewable, 20-year renewable to age 65. It can be convertible at age 65. That's just like term insurance, basically. You can do all that depending again on your affordability and everything. Or you can buy permanent one. In other words, covers you till age 100. Obviously, very, very expensive. So you're not going to get too many people buying that. But you usually will find people will buy to age 75. It's a fairly common type of thing. So in other words, depending on the client's ability to pay, they can buy obviously whatever what kind of plan that they want. You can add waiver of premium as a rider, okay, and that's standard, pretty well standard. And you can also add a return of premium rider. Now that's an interesting one because return of premium. Remember that ROP. The idea is that if you don't have any ailment at the end of the expiry period, you're going to get your money back. So, for example, let's say you bought a 20-year term, and at the end of the 20 years, you were fine, nothing happened to you, and they'll refund you all the money that you paid in the last 20 years. Or you had up to age 75, let's say, and you were 40 years old at the time you purchased it. You have 35 years. You paid $1,000 a year. You paid $35,000. Nothing ever happened to you. You were fine. You're going to get a check for $35,000. So that's the beauty of that return of premium. And again, that return of premium, the money that you get from that is all tax-free as well. So just like the benefit is tax-free, so is the return of premium tax-free as well. Speaking of taxes, premiums are not tax-deductible. Okay, you cannot deduct the premiums. Premiums do not qualify for medical expense tax credit. In other words, when you do your T1 filing in April, all that, there's no medical expense tax credit. Okay, benefits, of course, received a claim or the return of premium are all tax-free, as I said before. So all the benefits under critical illness totally tax-free. You will definitely get at the very, very least 2 questions on critical illness. Okay, this is a very, very popular plan. The other popular plan is long-term care. And this, of course, is for people who are who are not able to take care of themselves. Okay, so you can buy, you can go into public or private facilities depending on your affordability. Public ones, of course, are funded by the province of your wherever you happen to be living. Private ones are no funding from the province at all, but there could be quite substantial, very, very expensive. Like in a hammock, for example, I think it starts at $6,000 a month after tax. So it's pretty expensive stuff. Okay? And the idea is that it covers expenses basically to basically give you a comfortable, reasonably comfortable lifestyle while you're in long-term care facilities. So it could be a low-cost public provided, or it can be very expensive. Like I said, the private facilities are very, very expensive. The most common services are available, and again, depending on your affordability, you can buy a policy that only covers you for home care. Okay, most people like the idea of being taken care of at home, but they have to pay for a private nurse to come and visit them, stay overnight, all that kind of stuff. It's expensive. So therefore, you can buy home care. You can also buy something that provides respite care. If you think taking care of children is very difficult, try taking care of an adult. Much, much more expensive and very so sometimes you need just to get away. Okay, well, who's going to pay for that individual who's going to have to come in to take over your spot because you're on respite care? Who's going to pay for that 2 weeks, 3 weeks, 1 month, whatever that you're going to be away? You have to have somebody else take care of that individual. Who's going to pay for it? You can buy respite care. Okay, you can buy a policy that provides assisted living, like an Amico, for example, is an assisted living type of situation. Or you can buy nursing home care. So in other words, a long-term care facility whereby a person is actually living in a long-term care facility. Again, it could be public, it could be private, and whichever way you look at it, long-term care whether it's home care, respite care, it's an expensive proposition. So the premiums are quite high on this. This is one of the difficulties that you have in trying to sell some of this stuff because it does tend to be rather expensive. Okay? So what are the ADLs? This is very, very important, and you will definitely get a question, at least 2 questions on what are the ADLs. ADL stands for Activities of Daily Living. So as we read these things, you'll see these are things that we do, okay, every day of our lives. Okay? In other words, dressing ourselves, bathing ourselves, toileting, transferring, eating, maintaining continence. Continence being your bladder, basically, able to keep the bladder in check and everything else. Okay, these are things that we do, especially the first 5, what they call the first 5 ADLs. All of us have dressed ourselves today. We've all had a shower, a bath. We've all gone to the washroom. We've all moved around. We've all eaten, basically. Okay, but people in long-term care facilities, many of them can't do any of these things. Okay, so the end result is that if you cannot do 2 or more, and that's the key, if you cannot do 2 or more of anything that you see on that pink part, okay, you can put in your claim for a long-term care claim. Okay, basically, so you cannot dress yourself, you cannot bathe, you cannot toilet, whatever, 2 or more, you then qualify to put your claim in for long-term care. So think of long-term care like disability insurance for the elderly. Because what you're doing, you should buying is the $3,000, $4,000, $5,000 a month benefit, and you pay accordingly, essentially. Okay, so once you get admitted to these services, because you cannot do 2 or more of these, you can put in your claim, and therefore start getting a check. Companies also today also will cover you for what we call cognitive ability. In other words, mental illness is also covered. Not every company does this. Once again, read the material you've got from your respective company to make sure that it is covered. Okay? But basically, cognitive ability is mental process, memory, judgment, reasoning, cognitive impairment, basically. And so, in other words, if a person has a stroke or Alzheimer's, basically, they can also qualify for long-term care as well. But you probably won't get a question on the cognitive ability, but you most definitely will get questions on the ADLs. So make sure that you know. And once again, it will be all the following are covered under activities of daily living, except driving a car or something or whatever, that kind of stuff there. So you need to know. Whenever you see a list, by the way, usually it's an except type question. Okay. All right, let's go on. And once again, what are some of the riders that could be added to long-term care? COLA. Strongly recommend COLA. When you buy this, you could be 50 years old and you say, well, I'll buy $3,000 a month. That may sound like a great number. It gives you a decent amount of income. But you may not need the service until you're 75. And if all you bought was $3,000 and it didn't keep up with the cost of living, at age 75, that $3,000 may only buy you a ward, may not buy you a private room, or a semi-private room. So COLA is really, really important because it will keep up with inflation, basically. So that way, your $3,000 by the time you're 75 may be $5,000, and therefore, once again, you can get a private room, which was what you wanted in the first place, because you can afford it. So I would strongly recommend that you add the COLA clause in there. The other clause that you may want to add is return of premium. Okay, and again, read what the insurance company in question has, what their definition is. But basically, the ROP is at the end of 10 years, you'll get 50% of their money if you cancel the plan. At the end of 20 years, if you cancel your plan, you'll get 100% of your money back. That's a fairly typical definition of return of premium. But once again, I urge you to make sure you read whatever the insurance company you're dealing with, what their definition of ROP is. Once again, premiums are not tax deductible. They will not qualify for medical expense tax credit of any kind. Okay, and of course, the benefits once again are totally tax-free as well. Okay. The most group insurance plans and private plans and all that have what's called extended healthcare benefits. Okay, and these are benefits that are over and above the amount that you get from your provincial plan. So, for example, for those of you who are in Ontario, you're covered by OHIP. Well, OHIP doesn't cover everything. I know we always think we got universal healthcare. Well, it's not quite that universal. Okay? There's lots and lots of stuff that they don't cover. For example, one of the most common things is they only cover a ward in a hospital. They will not cover semi-private or private. As simple as that. And therefore, if you want a semi-private or private, you're going to have to crop up the difference essentially. But if you have an extended healthcare plan, a private healthcare plan through your employer or an individual plan on your own, then you can, in fact. So that's why I'm saying you can buy individual extended health insurance, or you can buy group extended health insurance. So it depends on where you're at. Regardless of which one you have, it will cover the medical care, in other words, your hospitalization, your doctor, if you have to go to see your doctor, it will cover dental care, it'll cover drugs, it covers a whole list of various different things, okay, that are not covered by your provincial plan. There's also travel insurance, okay, in there as well. So basically the three big areas that extended healthcare does is medical care, dental care, and travel insurance. And there are two kinds of healthcare. There's what we call reimbursements and direct billing. Direct billing is the most common today. In other words, when you buy this product, they give you a card, and then you show that card to the drugstore or your dentist or whatever it is, and they automatically turn around and send it all in, your claim in, and and everything is covered except for a piece that they don't cover, let's say the co-insurance piece, whatever, A reimbursement one is less popular today, but nonetheless available. This is where you have paid your doctor already, or you paid your druggist or whatever out of your own pocket. Now, they give you an invoice, you send that invoice, a receipt, in other words, you send all that into your insurance company, and they send you a check. So direct billing, your provider sends it directly to the insurance company. Reimbursement, you already paid it, and then you send in your invoice to the insurance company, and they will send you they'll send you a check, basically. Okay? In all cases, regardless of the kind of plan you have, there's the deductible and there's a co-insurance factor. So for exam purposes, the deductible is always an annual deductible. Okay, it's an annual deductible. I realize there's all kinds of different deductibles, co-pays and all that, but for exam purposes, it's just simply a deductible. It will be an annual deductible. And then the co-insurance factor is after the deductible, and that could be 80% all the way down to 60%. I've never seen a less than 60%. It could be 100%. In other words, the insurance company covers everything after the deductible, okay? Or they may only cover 80% of the benefit, or they may cover 60. Again, on the exam, they'll give you what the deductible is. They'll say this is an annual deductible of $150, whatever, and this is the co-insurance of 60% or 80% or whatever. So they'll give you all that information. You just need to know what to do with those numbers. And I believe there'll be an example on that in the book, as well as what we're going to talk about today. Okay? So let's take a look at the dental care first of all. This is the one that most, besides the drugs, this is the one that most people go towards. Okay, and again on the exam, they're going to ask you a question about this particular one. Okay. And all the dental plans must cover, use the word must, okay, must cover routine maintenance. In other words, this is the basic dental plan. So whenever you buy an extended healthcare plan, this is the minimum that they must cover. They must cover the routine maintenance, which is regular checkups, periodic x-rays, cleaning, fillings, and extractions. Okay, these are basically the most essential coverage of it all. So on the exam, they're going to say that all the following are covered under routine maintenance except, and what is the except will be crowns, will be dentures, will be, what am I looking for? Cleaning, teeth whitening, things of that nature. Those are not covered. Okay, those are endodontic situations, periodontic situations. Okay, so what every dental plan must have, the minimum that they must have, is what we call major restoratives. Basically routine maintenance rather. So they cover regular checkups, periodic x-ray, cleaning, fillings, extractions. Okay? And as assessed, usually the plan has an annual maximum of around $1,000. It could be less than that depending on what you buy, and a co-insurance factor of 20 to 25. In other words, you pay 20 or 25, the insurance company will pay the balance basically. Okay, it does not cover major restoratives such as root canals, inlays, crowns. In other words, on the exam, they could say all the following are covered except which one, and they'll say root canal, for example. That's the one you're looking for. Root canals are not covered. So major restorative services such as periodontic or endodontic, in other words, root canals, crowns, inlays, all things of that nature there, they are not covered under routine methods. Maintenance. Only those 5 that you see on your screen are covered. Okay. And also on the major restorative, the co-insurance is usually much, much higher. In other words, you pay 50%, insurance company pays 50%. But again, read the material that's in front of you from your insurance company to make sure you get these. But for exam purposes, what you need to know is what is covered under routine maintenance and what is not covered. Okay. And group insurance plans, of course, and extended healthcare plans all have travel insurance as well. So emergency medical expenses. So doctors and nurses' fees are covered, hospitalization costs, medical equipment, ambulance charges, dental costs, if it's an accident. In other words, this is not your normal dental things. It has to be an accidental injury or something. Okay. It also covers, of course, loss and damage, luggage. I'm sure all of you are familiar with that. Trip interruption, if you have to return because you're ill or you're injured, they have to return you back. Or we have to repatriate the body. In other words, you die overseas, and they have to send the body back to your province of residence. Basically, those are all things that are covered under the travel insurance package. Basically, okay. It is somewhat limited. You should have your own private travel insurance that will enhance this. But if you have extended healthcare, there is a basic coverage. At the very least, you've got something rather than nothing. But remember that there are going to be limitations on how much is covered and so on and so forth. The definitions could be a little bit different. So once again, make sure that you read the material that the insurance company sends you to make sure that you're not misleading the public or anything when you sell the extended healthcare travel portion. So we talked about deductibles, and on the exam you're going to get a question about deductibles. And I said to you that the deductibles are basically annual deductibles. That's really what we're saying. So what we've got here is John and Marcia, a married couple with 2 children, Colton and Jane. John is a member of a group extended health insurance plan that covers this whole family for dental claims, and so on. Okay. So it has a $100 individual deductible and a family deductible of $250. Okay. So basically, what we're saying is that the entire deductible maximum is $250, but each member of the family has a $100 individual deductible. So it's very important that you know the distinction between this. So each member has a $100 deductible, but the entire family is only $250. So let me explain. Okay, so this is very important that you follow. So the first claim is John, February of this year, let's say, and he had a claim of $80 because he has about a $100 deductible. Okay, therefore it's $80 is all he doesn't get any money. So basically no reimbursement whatsoever because he has a $100 deductible. He's used up now $80 of that. Okay, but he doesn't get anything because remember he has to get rid of the deductible first before he gets any kind of reimbursement. So in this case here, they've used up $80 of the $250 family deductible. So because they've used up $80 of the $250, the family deductible gets reduced now to $170. You see that, $170. So he had an $80 claim. They deducted $80, and so therefore he got no reimbursement, and the family deductible is $170. Okay? Then his wife Marcia goes in the next month, and she has a $120 claim. She has a $100 deductible as well. So now she gets reimbursed $20 because $100 is deductible. But notice that the $170 now, because they've already used up $100 now of the family deductible, the family deductible is now down to $70. Okay, so we're chipping away, you see, at the family deductible. Marcia goes back in again in April. She gets another $110. She has no deductible because she's used up her $100 already, you see. So for the rest of the year, Marcia doesn't have to worry about any kind of deductible. So the family deductible still remains the same, $70, and she gets $110 because her deductible is all taken care of. She doesn't have to worry about any further than that. John now goes back in May. He has $100, but remember, he only had $80 to use up of $100, so he still has a $20 deductible that he has to use up. So therefore, he gets a check of reimbursement for $80 from his $100 because he had to use that $20 up. And once again, the deductible, the family deductible, goes from 70 down to 50. Okay, from 70 down to 50. Now Colton goes in. So in July, he has a claim of $70. He has an individual deductible of $50. Remember that family deductible. So even though theoretically Colton has a $100 deductible, we've already used up all that deductible. We only have $50 left. So the only thing we can deduct is $50. We can't deduct $100 because you only get $50 family. In other words, the entire family deductible is maximum $250. So by the fact that we've already used up $200, we've only got $50 left. So even though Colton has a $100 deductible, he is only going to use up 50. So therefore, after 50 of the 70, he's going to get a check for $20. Colton in September goes in with $130. He gets $130. His sister Jane goes in November with $100. She gets $100. You see, because the family deductible of $250 has been completely used up once Colton puts in his claim. So that's the important part to remember. Okay, is that everybody has a $100 deductible, but we must also keep in mind that the entire family deductible is $250. So as we use up the individual deductibles, then the family deductible gets reduced, okay, to a point where there is no more deductible. So therefore, all future claims, regardless of who puts them in, will be completely paid for, with the exception, of course, of the co-insurance. So hopefully I've explained this the best I can. It is explained in the book as well, but you will get a question like this on the exam. So I strongly urge you to make sure you understand what's on that screen. Okay. Now let's talk about business insurance. We talked about individual and everything else. What about business insurance? We always think in terms of individual coverages, but business people also have very, very specific needs. Okay. So risk faced by business owners is the inability to work due to disability. For example, as a sole proprietor, for example, since you are the main person delivering all the goods, you might say you're making all the money, when you become disabled and you're a sole proprietor, there's nobody else that's driving the business, the income stops. So therefore, if you're asked in the exam, what's the most important product for a sole proprietor, you may say, well, life insurance, obviously, actually the most important product for a sole proprietor is disability and or critical illness, because if the person could be disabled, income stops, but the expenses continue ongoing. And so therefore, disability insurance is very, very important for business people, very important, okay? because they're not able to do their work, they may be unable to sell the business. Okay, in other words, they have to trigger to sell the business, but nobody's going to buy it. Okay, so therefore they need to trigger that disability policy in order to have some kind of income, so that way they can take their time and sell the company over a period of time. They could also lose the key employees. So even though you may have employees working for you, because you're the driver of the business, and now that income is slowing down or stopping or whatever it is, the employees may get nervous about it. Next thing you know, they say, I've got to leave, because after all, I got to take care of my family as well. So there's a lot of issues for business people. You know. On the exam, you will definitely get a question on BOE. Okay, you'll probably get 2 or 3 questions on BOE. It's very, very important. Okay, business overhead expense policy. Okay, so business overhead expense insurance pays for business operating expenses in the absence of a disabled owner. So, for example, rent charged for business premises, an expense paid by BOE. So, what we're saying is that in this particular case, this is not insurance for the owner. This is insurance for the business. So, on the exam, they're going to ask you a question: is what is not covered under BOE, and what is not covered is the owner's disability income. In other words, the owner should have a separate disability policy. So if I asked you as a dentist, how much money do you need to cover all your expenses? You say to me $20,000. How much of that is your take home? And you say to me 5,000. Then I cannot cover you for that 5,000. All I can cover you for is 15,000. So the owner is absolutely not covered. Okay, or anybody that is able to earn their own income, even though they may be working for it, but they may be independent contractors, they're not covered. Family members are not covered. Okay, so it is very important that you go through the list in the book as to what is covered and what is not covered. It is very well explained in the book. What is covered is the cost of doing business. So, for example, your employees, they must be true employees, okay, not contracted, and they must be on payroll, basically, T4 income, basically. Your heat, hydro, your taxes, the interest on your loans, equipment that you're buying, all those things there are all covered. Okay? But the owner's income is not covered. Also, the definition, and by the way, the definition for business risk is always own occupation. Okay? It's not regular, it's not any, it's always own occupation. Okay? So the tax treatment of BOE is that the premiums are tax deductible expense. It is a cost of doing business. Okay, so the premiums are tax deductible for business expenses, but the benefit received is also taxable. Okay, so the money, so if I send you a check for $15,000 a month, let's say, you need to report that as income. Okay, however, the expense covered by BOE insurance are themselves tax deductible and therefore offset. In other words, yes, I send you a check for $15,000. Remember, you spent $15,000 as well. In other words, it's a reimbursement contract. So really it's a wash. But if you're asked on the exam, is the premium deductible? Yes. Is the benefit taxable? Yes. Do you actually pay any tax? No, because one offsets the other, basically. So please read over that in the book because it explains it very, very well. The next thing we'll look at is the disability buyout insurance. And this happens, of course, in a situation where there are two or more people who own the business. And if something should happen to that individual becomes disabled, who's going to buy out the other person? So if you remember, we talked about buyout insurance when we talked about life insurance, and we said that the buyout, basically the buyout agreement, says that if I become disabled, you're gonna buy me out, or if you become disabled, I'm gonna buy you out. Basically, this is a very, very important document. So normally, what happens is you go to your lawyer and you set it all up. You actually put an agreement together, which we call disability buyout sales agreement, buy and sell agreement, basically. And what will happen is that in that agreement, it specifies what happens if I become disabled or you become disabled. How do we trigger the buyout? So it's a very important document. So basically, what we need to do then is we need to fund that arrangement. And we can fund it on a crisscross bit. In other words, I insure you, you insure me. Or it could be a situation where the company itself buys the insurance on me and the company itself buys the insurance on you, let's say. So I become disabled. Okay, after a period of time, the waiting period, which they call the trigger date, the money gets paid out, and basically I get the check, and then I hand over the shares to the company, or hand over the shares to you as my partner. Okay. The taxation of capital gains or loss for the seller, there could be some taxation issues, obviously because I have sold the business, so there could be some taxation issues. Okay. Once again, because it is business insurance, it is an own occupation definition. Okay, so it's not any, it's not regular. Waiting period, sometimes called the trigger periods, okay, it can be anywhere between 12 to 24 months. So this is not something that kicks in after 3 months or something. Usually these things here are much longer. So in other words, at the end of 12 months, if I'm still disabled, let's say our agreement said at the end of 12 months, we're going to trigger the buyout. So in the 12 months, I'm still disabled. You, as as my partner, can trigger the buyout. In other words, put in our claim, and I get a check from the insurance company. I hand over the shares to you, and that's the end of it. Okay. Coverage could be up to $2 million. It could be more, but generally speaking, in Canada, because it is a small market, generally speaking, up to $2 million. You could renew, could be a renewable policy, a convertible, kind of unusual, but it is available basically. You can have a future purchase option. This is an important option because remember, with future purchase option, you can simply buy more insurance in the future without medical evidence. So today, our business may be worth $1 million. I insure myself for 500. You insure yourself for 500. But what happens 10 years from now when it's worth $2 million? And we need more insurance. Once again, if we are healthy, the insurance company happily sells more. But what if we're not healthy? Okay, and so therefore, the FPO is a good rider to have because it allows us to buy more, basically disability buyout insurance in the future without medical evidence. Just pay the attained age premium. Okay. Once again, premiums are not tax deductible, and of course, the benefits are totally tax free. Okay, so basically, if you're insured for 500,000, I get a check for 500,000 tax free, and that's it. Okay. So this is again a very, very important section, and you will get a question on the exam on disability buyout insurance. There's also in business insurance we're called key person disability insurance, and this is basically every company out there besides the owner of the business usually has one or two people that are very, very crucial to the success of the organization. Okay, it's just like you insure your building and your equipment and all that sort of stuff there, you should insure also the most important people that make this thing work, and that is your key people. So once again, because it is business insurance, it is own occupation for your key people as well. Okay? And it could be a product that is guaranteed renewable, it could be conditionally renewable, it all depends on what you're buying basically. Again, riders could be added to this, waiver premium, recurrent disability. Remember that 6-month recurrent disability, replacement expense riders. In other words, there's a number of options that are available as well. The benefit is a salary of the key person up to around $15,000 per month. Okay, so it's really disability insurance, 60% off the earned income of the key person involved. It's really the same formula. But it can go up to $15,000 per month. Waiting period, generally speaking, 30 to 90 days. It could be longer, it could be shorter. Don't recommend shorter; it's very expensive. But basically, 30 to 90 days. Benefit period, very rarely beyond 12 months. Okay, let's face it. If this individual is disabled for longer than 12 months, likelihood is this person is never going to come back to work anyways. In other words, a permanent disabled. So as an employer, you want to cover them for a period of time, basically, hoping that they'll recover and come back to work. So generally speaking, 12 months. But again, it doesn't have to be 12 months. It could be more. It all really depends on what the decision of the owner is. Okay. The policy is, of course, owned by the business. In other words, I buy a policy on your life. Okay. However, the premiums are not tax deductible and the benefits are tax free. Okay, so whatever you've insured for me, $15,000 a month. Remember, you're paying the premium. You're doing all the employer's paying the premium and all this. Okay, but when I get that $15,000, it is mine, and it's just totally tax free. Okay, so key person disability insurance, just like key person life insurance, very, very important product for people other than the owner themselves, which they should have their own plan anyways, but this is for individual key people. Okay. Now, when we look and sit down with the client, one of the things that we all have to do today, because of compliance, regulations, and everything else, the industry today has huge compliance issues and everything else, regulatory issues. And we need to now look at a client profile. In other words, what constitutes a client, basically? So we have to look at their own personal situation. What is it that makes them tick, you might say? What's their financial situation, including income and expenses? In other words, do a complete needs analysis. How much money is coming in? Where's the money going? That kind of stuff there. And then we need to discuss the various different insurance options that are available based on the profile that the client has given you. So let's take a look at a few situations that you will come across. Okay, first of all, we looked at based on the personal needs, their financial situation, and existing insurance coverage. In other words, if you did become disabled, Mr. Jones, how much money must you have net of taxes and everything else in the door every single month during the time that you're disabled? In other words, there's your personal needs. Okay, we need to take a look at your financial situation. Is there any other income that could be, in other words, do you have savings accounts that we could tap into in the event you became disabled, or do you have a trust income or whatever, In other words, let's take a look at your situation. Do you have any existing insurance, either through your employer or individual plan or whatever the case may be? So we need to take a look at all of those factors, basically. Then we analyze the existing coverage. Okay? In other words, if the person says, yes, I do have coverage, here it is. Let's take a look at the difference between the coverage that he has and the need that he has. He may say, yes, I'm insured by my employer for $1,500 a month. Okay, is that enough? Okay, he said, well, no, not really, but that's all they give me. That's fine, but you need extra, so you need to supplement that. Okay, one of the things, of course, you always have to tell them is that in the event that they lose their job, there goes the coverage. In the event that that their employer decides not to have any more group benefits because it's too expensive, there goes the coverage. So while having group insurance plans, LTD, FCD are nice things to have, they're not guaranteed. Okay, the employer drives this, and if the employer decides to hell with this, I'm not going to do this because it's too expensive, or I need to cut back on staff, and now you lost your job, that's it. You have no coverage. So really, you got to be careful of that. Okay? Of course, there could also be overlaps in coverage. In other words, you got too much coverage, and only one company will pay you. So we may want to say, well, in that case, then why pay two premiums? Why pay all this money? So we need to take a look at that kind of stuff. What's the existing waiting period? Okay, is that okay? If it's a 90-day waiting period, and you're telling me that you need money within 30 days, that may create a problem for us. Okay, so we have to take a look at that. What about benefit period? Okay, you're 45 years old and you only got a 2-year benefit period. That's not very good. Okay, maybe you should have a 5-year or 10-year benefit period or something. Again, take a look at these kind of things, depending on, because things change, right? And what are the are there any restrictions that may be imposed? In other words, some group plans, for example, make it very, very clear that if you do certain things, we're not going to pay. Okay, and they list those things, whatever. So there may be some restrictions on the group plan that may, or there may be some restriction on the individual plan that may no longer suit. It was okay when they did. So, for example, when they did do original plan, they were skydiving, let's say, and disability plan says we will not cover you, if you're skydiving. Now, the individual, 15 years later, 20 years later, no longer skydives. Well, then we should take that restriction off. We should apply to the insurance company to take off that restriction, and by doing that, lower the premium and so on and so forth. Okay, that sort of stuff there. So we need to take a look at the client, profile that client, make our recommendations, things of that nature there. Okay? When we look at group insurance, do the same thing. What's the makeup of the group? Okay. In other words, if in terms of what kind of a group is it? Is it in other words, the nature of the business? Is it a construction firm or is it a white collar firm? Number of members. The more people we have, the better the group plan is. Okay, because we're spreading the risk. Remember that the entire purpose of group insurance is to spread the risk. That's the entire and so therefore, the more members we have, the lower the premiums for everybody, because you can basically spread the risk out to more people. Age and gender. Okay, in other words, a healthy mixture of young people and old people. Let's say if you have an old people only, premiums can be very, very high. Okay, so you may want to have a mixture of older, younger people, gender, male, female. Again, we have to look at a nice mixture of male and female. If it's all female, for example, it's going to be a lot more expensive because females put in more claims. It's as simple as that. Okay, so therefore, a healthy mixture of age and gender is very important. Your turnover rate. This is very important for insurance companies because what they call basically, claims could be derived from if turnover rates are too high. So in certain areas, for example, where there seem to be always firing people, hiring some more people, all that, insurance companies get very nervous about that because it could be what's called anti-selection against the insurance company. Insurance companies like stability. They like an organization where the members have been there for a number of years and everything. Nice, stable environment. If you end up having an environment where the turnover rate is 30, 40, 50% year by year, then they're going to charge you a premium for that because the risk is simply too high. It's as simple as that. Like I said earlier, the nature of the business, what kind of work is it? We compare your business to other businesses and to try to establish the premium rates and everything else. Of course, we ask for the employee data sheet. Again, on the book, your module there, it does quite an explanation of the employee data sheet. So we need to know the name of the individual, is it a family member, guess it's family coverage or single coverage, how much money are they making, so we can insure them accordingly, and so on and so on and so forth. Okay, so there is an employee data sheet that the insurance company will request from the employer in order to assess the risk and everything else. Okay. The next section, which is called group plan cost, you must know these. Okay, you will definitely get a question on all of these for sure. Okay, you may not get a question on the makeup of the group, okay, but you will definitely get a question on these premium rates. So the first thing we'll look at is what's called manual rating. If it's a brand new group, then they use the manual rating. In other words, on the exam, they're going to say, how was the premiums calculated, basically. So they'll say XYZ company has 20 employees, and now they wish to put in a group plan because they don't have one. They've never had a group plan before. What system, what premium rating, how is the insurance company going to calculate the rating? They're going to calculate it by using what's called the manual rating. And basically, a manual rating is they look at similar types of businesses that you're insuring and say, what was the rating in that? And they use that sort of as a place to start, you might say. So if you have a company that has brand new group plan, they use manual rating. If you have a company that has an existing plan, then they use the experience rating. Because in other words, we know what the cost is. So for example, if the premium is $60,000 and the claims are $70,000, the insurance company's lost $10,000. In other words, it's a deficit of $10,000. Well, obviously, experience is not very good because we lost $10,000. So guess what? They're going to take that $10,000 and they're going to add it into next year, and the premiums go up, basically. In other words, we have experience, right? And so therefore, if there is an existing group, they use the experience rating. If it's a brand new group, they use the manual rating. And if it's a large group, they use a blended rating. In other words, they'll use the numbers that they have, you'll use experience, and they'll use manual. So for very large groups, usually 150, 200 employees or more, that kind of stuff there, they will use the blended blended rating. Okay, so the definition basically is very important. So again, I urge you to go to your book because it does give you a very good explanation of these three. So you will definitely get a question. So the question will be really quite simple. XYZ is brand new. What do they use? Manual. It already has an existing group. What do they use? Experience. It's a very large group. What do they use? Blended. Okay. And the last one is credibility. And this is really goes back to that turnover rate. If the company has a very high turnover rate, then the credibility is very low. And so therefore, they're going to add an extra premium. In other words, a protection, just in case of bad risk. In other words, anti-selection. If, on the other hand, the turnover rate is very, very low, the credibility will also be very low. Probably will just charge you a normal rate and everything else. But if it's a high turnover, whether it's manual, whether experienced or blended, if the credibility is high, they're going to charge you an additional premium over and above the standard premium that they would cover you for. Okay. The next thing we look at is, of course, is there any kind of existing coverage on your group plan? The existing plan design, does it fit the client's needs? We look at the claims experience, of course. We look at satisfaction. Are you happy with your current provider? Are you not happy? That kind of stuff there. We may propose a new type of coverage. Mr. Jones, I notice you don't have coverage in this area. You really should look at that. Okay? Once again, you probably won't get a question on those, but you will definitely get a question on the next one, which is funding formulas. Okay, you must know these. Absolutely must know these. Okay, so if it's a small group, less than 25 lives, some companies say 30 lives. Okay, so if it's less than 25 or 30 lives, they use what's called a non-refund accounting. Non-refund accounting. Let me explain. Going back to my example, the premium was $60,000. The claims was $70,000. So the insurance company lost $10,000. The insurance company cannot go to your employer and say, look, we lost 10 grand, give us a check because we lost the money. No. See, the definition of a fully insured group plan is really quite simple. The insurance company pays the claim, the employer pays the premium. The employer was asked by the insurance company to pay $60,000. Okay, so they paid it. So the claims were $70,000. In fact, the insurance company lost $10,000. Well, that's too bad. You're going to have to take that $10,000 because the experience is not very good. It's a deficit. They roll it into the following year. Premiums go up. Okay? However, what if the premium was $70,000 and the claims were $60,000? In other words, the insurance company made $10,000. The employer cannot go to the insurance company and say, hey, you made $10,000, you overcharged us by $10,000, give us a check. Can't do that. You see, that's why they call it non-refund. In other words, in a small group, everybody maintains their position. The employer does not have to pay anymore if there's a deficit, and the insurance company doesn't have to pay the employer if they made a profit. Okay, simple as that. So non-refund. In a large group, on the other hand, we have refund accounting. So refund accounting basically means that the employer participates in the profit of the insurance company. So in this case here, let's say that the premium was $200,000, but the claims were $250,000. In other words, they lost $50,000. The insurance company, once again, cannot go to the employer and say, we lost $50,000, give us a check. Because remember, the definition of fully insured says you pay the claim, which we did. So you pay the premium, which we did, $200,000, and you, the insurance company, paid the claim, which is $250,000, and that's the end of that. Okay, so the insurance company, once again, would take that $50,000, add it into the following year, and off we go. Okay, this is where it becomes interesting. What if the premium was $250,000 and the claims were $200,000? In other words, the insurance company made $50,000. What will happen now is the insurance company will refund a portion, sometimes 10%, sometimes a little bit less, sometimes a little bit more, depending on how you negotiate this thing, But basically, what will happen is a portion of the profit that the insurance company made will be refunded to the employer. And that's why they call that the refund accounting. So non-refund accounting is for small groups. Refund accounting is for large groups. That's essentially what we're saying. So refund accounting is for large groups. Okay. The last one is ASO. Administrative services only. ASO basically is not an insurance plan. It's not a fully insured plan. This is a plan where the employer pays everything. Okay. In other words, I, as the employer, will open up an account for each one of you. So there's 10 of you, let's say, and I'm going to open up an account and we're putting $2,000 into this account for each one of you. And you don't have to pay a dime. It's all me. Okay. And therefore, when you have a claim for your dental or your drugs or whatever, okay, you don't bring your claim to me. You go to an ASO, okay, an administrative service only, and they will administer the whole thing for me. Okay, and so therefore, I basically hire a company that is an ASO company, and so I've got 10 employees. I would like to put in a plan, non-insured plan. Okay, I will put in $2,000 for each one of my employees. So I've got 10 employees. Here's $20,000. Then the ASO will charge, of course, for the administration. Let's say another $2,000. So cut me a check for $22,000, and everything will be wonderful, basically. Okay. So in ASO, the main thing to remember is that it is not a fully insured plan. Okay, there is a limit, there's a cutoff based on what the employer has decided to contribute, basically, and that's it. So unlike the non-refund and refund account, which is fully insured, ASOs are not fully insured. It is strictly the employer pays everything. The employee pays nothing, and as a result, we cap the cost. So usually, what happens here is that very large organizations tend to go towards ASOs so they can limit their cost and everything else. Okay. The important thing to remember, and what is the danger of using an ASO, is that next year when the $200,000 are due or the $22,000 are due, the employer may not have the money. So the danger of using an ASO is claims may be too high, but more importantly is that the employer may have a bad year or have expenses that they cannot afford to pay the premium. in other words, cash flow. So the employer may not have the cash flow to pay that premium. And so therefore, there's nothing else that can be done. Excuse me for a moment. Oh, there we go. So the premium payment responsibility, there are basically what they call contributory and non-contributory group insurance plans. Contributory plans basically is the employer and the employee essentially split the cost 50-50. Non-contributory plans is the employer pays everything. Okay, so basically an ASO is a non-contributory plan, and that the employer pays everything. Whereas non-refund and refund accounting basically could be both. It could be, some could be the employer pays everything, in other words, non-contributory, or they could be contributory where the employer and the employee basically split the cost 50-50, that kind of stuff there. So it all depends, again, on the employer. Okay. That is it for today's lesson. As always, if you have any questions at all, and if you have any concerns or misunderstandings or whatever it is, just contact us. Look at the email address that's on your website, basically, and email me, and I'll be happy to answer all of your questions. I'm going to stay on for a few more moments. If you have any questions at all, you can ask them now, or like I say, you can email me on that. So for now, I will bid you a good evening, and let's see if there's any questions.